everyone. It is 10 a.m., almost 10:01 a.m., and it's Halloween, 31 October, year of our Lord 2023. And I am about to start a new lecture in personal finance. So I'm going to jump on over to my Zoom room and start the meeting and see how many folks we have. Looks like I have an issue with my Zoom. I need to fix it. There we go. Last week I made a mistake. I make a mistake every week, but last week I had, let's see, I've got my microphone correct. But what I want to do is go to the Ecamm Live virtual mic. So this should fix my problem. Hopefully it fixes my problem. All right, now I've got speakers. Okay, I'm doing a little testing, sorry. This is for the folks in the Zoom room. Folks in the Zoom room couldn't hear the sound last week from my software. So here we go. I'm going to admit everybody. Welcome aboard, those of you who are joining on Zoom. By the way, if you're watching on YouTube or Facebook, I would appreciate if you leave a comment. Let me know you can hear me. Let me know you're listening. And hey, everybody. I see Ava, Christina, Cedra, Alani. Let's see who else. We've got some more folks joining. Welcome aboard to the Zoom room. We are going to, you can hear me great. Thanks, Christina. All right, let me get my chat up so I can see those special. Good morning, Ava. Happy Halloween. And it's cool. I love cool. I grew up in Michigan where it's very cold, and I like coolness. Okay, let me see. I am going to jump into get ready. Give me a second. So everybody's been doing a great job with your assignments. I think, hey Cedra, good morning. I think you're doing a great job. Those of you who are watching on YouTube and Facebook, I know you're not watching. Maybe not watching right now. You may be watching late at night, one day. But anyway, I welcome you, and I appreciate your good work this semester, this week as well. This last week we focused on asset allocation, and I want to spend just a couple of minutes reviewing what we've gone over before I jump into today's lesson. So we are live streaming to YouTube and Facebook. I think I'll get rid of that for a moment and just, I guess I didn't get rid of it. I must have just started it. Hold on. Buttons, live streaming. So, there we go. There's the live stream. So, yeah, I did want to, again, mention real quick that you can go to uhplaylist.com and you'll go to this semester's playlist. So, hopefully that's working well for everyone. I have too many buttons in front of me. I did want to, again, mention that all these videos are being loaded into a playlist at my YouTube channel, a new YouTube channel. So if you happen to be watching this stream on an older YouTube channel, it's being streamed to many YouTube channels. But those channels are all going to go away in the next 12 months, and this is the channel we'll be using. So thank you for that little public service announcement, letting me give you that announcement. Do you have any questions? Those of you who are in the Zoom room, one of the things you get to, Ava, you win, I think. Hold on, let me scroll down. Ava wins the 1,000-point bonus. It's really not 1,000. And Ava, honestly, I don't remember how many points you have in Canvas right now. But if you need points, you just keep track of how many times you won this wonderful opportunity to be the first one to ask the question, to remind me not to forget what is this week's class collaboration. And I will get there. But you have to remind me. So you win, but you have a responsibility, Ava, to make sure that I don't forget. So I'm not going to announce it just yet. It is now 10:05. It's time to get started. So let me see if I can do what I'm going to try to do in this little I'm thinking about all of the ways I can mess this up at the moment. So anyway, that was my thinking man. Now I'm going to try something different. And I wanted to highlight, I'm just going to review a couple of things that we've gone over for the last few weeks. One is we talked about the perfect investment, and I hope you remember that. I hope you remember what that perfect investment was. Right there it is, tax-advantaged 401k. Today we're going to talk about types of accounts. We're going to talk about tax allocation strategies, and you're going to get to see, I think if I hit this, you'll see, we're going to talk about tax allocation strategies. This is a way to reduce taxes and build wealth. And we're going to talk about types of accounts. And the 401k is really a type of account. It's the one we've highlighted for the perfect investment. But when I say 401k today, when I say a 401k type of account, I just want you to think about a company-sponsored retirement account. Okay, so 401k is really just one of those. There's lots. If you work for the government, it's a different number. The 401k actually represents a paragraph number in the IRS tax code. So just want you to know the 401k, which is what I called the perfect investment, is because you get a company match. It's tax deductible. You get tax-deferred growth, and you get kind of couch potato-proof investment management. So it's, in my opinion, as a fiduciary, I always have to say there is no perfect investment. But if there was one, this would be it. So the perfect investment, we've talked about that, how it works. I've reviewed that with you a few times. And hopefully by now you're feeling very confident to know that the day you start your job, you're going to know the answers to the questions that HR is going to ask. Do you want to participate in the 401k? The answer is yes. And the second question is, how much do you want to contribute to your 401k? And the answer will be, based on whatever that company match is, you want to make certain that you contribute at least enough to take full advantage of the company match. So that's the second question. And then the third question is what you worked on this last week in your homework assignment, which was asset allocation. So with asset allocation, we talked about 4 investment strategies last week and the week before. We covered 4 investment strategies. We also talked about asset classes. And I want to just kind of review for a minute asset classes, because that was something you worked on this week. I'm not going to review it a lot. I just want to remind you, I want to refresh your memory that this is what we covered over the last few weeks. And today we're going to build on that. Today we're going to build on that by talking about tax allocation strategies. So you may recall, let me just jump in here and see if I can get this to show up. Whoops, get rid of that. And I want to highlight the 3 laws of personal finance. So this course is structured with these 3 laws of personal finance in mind. We spent a lot of time talking about the law of spending and saving. And that law says spend less than you earn so you can save more for what matters most. That's probably the most fundamental law of personal finance in the universe. And yet it is one of the most disregarded laws of personal finance. And if you don't believe me, just look around and you'll see lots of folks who blow that off. If you haven't looked at the U.S. debt clock lately, I wonder if I can jump over to the U.S. debt clock. If I do that, I will surely mess things up. So before I do that, let me just go back to 3 laws of personal finance and just highlight those. The first is the law of spending and saving. The second law of personal finance is the law of tax-advantaged investing, and that's what we're going to talk about today when we talk about these investment types of accounts, tax allocation. When we talk about tax allocation and types of accounts, we're talking about tax-advantaged investing. So that's the second law of personal finance. And the third law, which I think is the most important, is the law of purpose and commitment. And so we've been having some fun talking about quotes and songs. By the way, the song that I played from Styx, that little clip that I played, remember that? Well, that got, what is the word? It got hit by YouTube as a violation. I had to actually tell YouTube to mute that section of every video that I played those clips. So I guess those algorithms work for copyright violations because I apparently violated the copyright. Okay, let's go back to where were we? Here we go. So let me just highlight well, before I do these asset classes real quick, let me just remind you of these investment strategies. So the first one was diversification. And we talked about Enron. Remember the story of Enron? And I shared about two different clients that I had. One who was diversified. She didn't put all of her money into Enron. So when Enron collapsed, she was my client and she had a good deal of money because she diversified. She hadn't put it all in Enron. She didn't invest all of her 401k in her own company stock because she was smart enough to know that if something goes wrong with my company, I'm already going to lose my income. I don't want to lose my retirement savings as well as my income. So when I talked to her about why did you do that, that was her answer. And it was obviously the right answer. So that's the story I've been telling for years about to highlight diversification. And I showed you a picture of an elevator with different cables, but I'm not going to show you that now because that button isn't in front of me. So diversification is the number one investment strategy designed to help you maximize returns and minimize risk. And all four of these investment strategies have that one objective in mind to help you maximize returns and minimize risk. Over time, these four investment strategies are selected perfectly for you because you're young, relatively young, and you have a long time horizon. And these strategies work really well with long-term investments where you have the market going up and down over time. So asset allocation is the next one. And asset allocation is where we have to get into these different classes of stocks or different asset classes. So stocks, that's an asset class. U.S. large cap stock is an asset class. U.S. small cap stock is another asset class. There's a whole, I can't even begin to go over all of the asset classes. I just want you to have a basic framework for the different asset classes that you will be wanting to look at and understand and select in your 401k. So we've got large cap U.S., small cap U.S., bonds, there's corporate treasuries, there's international bonds, and you should know the difference between an equity and a bond. When I say stock, U.S. stock, large cap, that's an equity. It means you have a part ownership in the company. A bond means you've invested in a loan, basically. So just spend a little time and understand the difference between an equity and a bond and know that there are different asset classes and they operate differently in each kind of market situation. So when we get back to these investment strategies, the next one after asset allocation, which by the way, asset allocation, remember, is the single most important determinant of your investment portfolio's returns. So I'm going to say that again. Asset allocation is well known to be the single most important determinant of your portfolio's returns. That's why I want you to understand asset allocation. That's why it's important for you to understand these different asset classes. Because if you understand them just a little bit, you will know enough to be able to use asset allocation as an investment strategy in your 401k. And I promise you over time, that's going to make a huge difference. When we get to dollar cost averaging, to me, this strategy, dollar cost averaging, is the most powerful investment strategy for someone who's young and has a long time horizon, because dollar cost averaging, if you'll remember the story of Farmer Joe, I'm not going to repeat it. or even really review it. I just hope if you didn't really get it, go back and watch that video about Farmer Joe and make sure you understand the concept of dollar cost averaging so that you can put it to work in your 401k and in all of your investment accounts. And over time, I promise you, there's no better way to build wealth over time than using the strategy dollar cost averaging. Again, all 4 of these investment strategies are designed to help you maximize returns and minimize risk over time, and they work. They work really well. So please spend some time and learn them so that you can put them to work for yourself right out of the chute when you start working and earning. Earning, that's a key word, Ava, earning. And just remind me, again, it's your job to remind me to talk about this week's class collaboration. And the idea is earning. Earning is the big idea that we're going to talk about this week in our class collaboration. There's more to say about that, and I want you to remember to remind me because I could forget. Thank you. I know you've got my back. I know you do. You won't let me down. You will. I see you in the chat. You're right there. I love it. Thank you. Okay, back to the strategies. The last one is really pretty simple. Portfolio rebalancing is just, I always think of a circle, think of a pie, maybe a pizza with 4 slices. When you start out, you put your asset allocation so that pretend you have 4 different asset classes. You may have 20, but let's just say you have 4. Let's say that you have these 4 that are listed right there: large cap, small cap, bonds, and international stock. And you could pick a whole variety of each one of those asset classes. There's lots and lots of ways to get exposure to U.S. large cap stocks. One of the ways I told you is the S&P 500, and my favorite investment on the planet is the SPY, which is an ETF, an exchange traded fund. We talked about the difference between a mutual fund, an index fund, and an exchange-traded fund. I'm not going to review that today, but those are some things I want to remind you to understand, to keep on your mind and remember and study a little bit, pick up a little information here, a little information there, and just understand that I'm telling you that the superior investment vehicle is an ETF, an exchange-traded fund. And when we get into tax allocation, you'll start to understand a little bit more about why the ETF is better typically than a mutual fund. It's cheaper. It's easier to trade. It's more tax efficient. So just 3 different investment vehicles that we talked about as well, in addition to asset classes. So don't be confused. Just start to remember these terms, start to nail them down in your mind so that you can use them as part of your schema for becoming a fearless investor. Because if you follow these strategies, these 4 strategies, they will make you a fearless investor. They'll help you maximize returns and minimize risk, and you won't be afraid of those times when the market is tanking or when certain asset classes are tanking, because back to portfolio rebalancing, you start out with these 4 investment strategies or these 4 asset classes. And over time, let's say that the large cap U.S. stocks turn into half of your portfolio. Instead of 1/4, it's grown so much. And let's say bonds have shrunk and they're just a wee little slice of your portfolio. Now it's time to rebalance your portfolio. And that's where portfolio rebalancing comes into play. It's kind of like dollar cost averaging in reverse. You have this big growth section in your portfolio and you want to sell it and take the profits and invest those profits in another asset class that's in the commode. Remember Farmer Joe's cows. He made a lot of money buying cows over time because the price of cows went up and down. And as he bought those cows using a strategy called dollar cost averaging, he was able to accumulate a lot more cows. And he was able to buy those cows when cows were in the commode. The price of cows was just down, down, down. He was able to buy more cows. And that's what you're going to be able to do with the investments that you place into your 401k. each of these asset classes become types of investments for you in your 401k or any other type of investment or any other type of account. Okay, so back to this week's lesson. Any questions? I don't see any questions. Okay, so we're going to talk about not asset allocation, tax allocation, which is another term for it is, let me just jump on over to my iPad. There we go. There's my iPad. And in this video, by the way, when I post this to the playlist, you'll see this video has a link to this post, and it's called Tax Allocation Strategies. So you can read this. You can go back and review it. I won't cover all of it. I just wanted to put some bullet points and some benefits and just kind of highlight what's important about tax allocation. And it is your homework assignment too. You're going to update your financial plan with tax allocation. But basically what it is we're going to talk about these types of accounts. So I'm going to spend a few minutes talking about types of accounts. And I have listed here on this little GIF file some types of accounts: 401k, traditional IRA, Roth IRA, but I'm missing a very important type of account. It's not even on the list. So what I want to do is I want to spend a minute and I want to review my buckets with you. These are my buckets. So I've had these buckets for a long, long time, and they're what I use to illustrate types of accounts. So I'm going to get my big ugly face out of the way and just use my little ugly face. And I don't know, probably I don't want to have this GIF going the whole time because that may be distracting. So let's just go back to here and give me a second. I'm going to go here. And I'm going to go boom, boom, and I'll just put this up. So these are just the bullet points I want to cover today. I'm going to put them all up. I think that's going to work. And then we'll put that up. So, let me get rid of that. We'll put this one up instead to remind you where you can find this video. So here we go. These are the big benefits of tax allocation. The reason I want you to learn this is because using tax allocation, just like using asset allocation, remember, tax allocation is all about tax-advantaged investment strategies, and it's part of the game of building wealth. But that's the main thing that tax-advantaged strategies are for. Tax-advantaged investment strategies, the second law of personal finance is, let me get rid of that video so it's not distracting. The main idea for any tax-advantaged investment strategy is to reduce taxes. Remember, we talked about the 401k being the perfect investment, and it may not make a lot of sense to you right now to know that you get a tax deduction when you put money in your 401k. The biggest benefit of that perfect investment is the company's going to match it. They're going to match your investment. That's a 100% return. But another big benefit is getting a tax deduction for every dollar you put into that 401k. You get a tax deduction, which means you don't have to pay tax on that money. The IRS says, hey, you put $10,000 in your 401k, therefore you have $10,000 less of income you have to pay taxes on. It's a big benefit, and over time it's a really big deal, and that's why tax allocation is a really big deal. If you're an earner, Ava, remember, earning is key. If you're an earner and you have earned income, then you get to contribute to these tax-advantaged investment, these types of accounts. So when I say 401k type of account, I don't just mean a 401k. You're going to do some study this week, and you're going to learn that the 401k, it's basically just the paragraph heading for a certain type of account. In the IRS tax code, it's listed in paragraphs, and there's this paragraph that is 401k, and that's what addresses the rules, boundaries, and limitations related to a 401k account. But there's 403b accounts if you work for a nonprofit, if you work for a school or a church. There's a 457 plan, I think, if you work for the government. I always kind of get the numbers mixed up, but you get the idea. There are all these different paragraphs in the IRS code that deal with specifics for what type of entity you work for. If you work for a for-profit company, it's a 401k, and that's why most people do work for a company, and that's why I always illustrate and the only one that I know of that gives a company match is the 401k. So if I'm wrong about that, feel free to leave a comment, and I'll be happy to announce that next week. But when I say 401k type of account, I want to show you what I'm thinking of. But before I do that, I want to tell you that I missed a very important type of account. And so I'm going to just quickly show you. I'm going to show you my buckets. So let me show you my buckets. Here we go. These are my buckets. And so the first bucket we have is this big blue bucket, which is the one I forgot. And this big blue bucket, it illustrates a non-tax qualified account. It's the biggest bucket I have in my hand. I have a bigger bucket in my utility room that I use to wash my truck and whatnot. So it's bigger. So imagine this is as big as it could possibly be, because this is a bucket that has no special benefits. It can be unlimited in size, huge, and it has a few rules, boundaries, and limitations. But the main thing about this bucket that's different from these buckets that I'm about to illustrate and show you is this big blue bucket, non-tax qualified. So you don't get any tax benefits. You get no kinds of protection in this bucket. You can get sued. You can lose all the money you have in this bucket if you get sued. It's just a big unlimited bucket for people that have a lot of money. Maybe they make too much money to be able to put into a tax qualified account, because these accounts that I'm about to illustrate, they have certain rules, boundaries, and limitations. One of those limitations is how much money you can put into these buckets right here. But this bucket, this big blue bucket, it's a non-tax qualified account, and that's what it illustrates, and it's not on the list. So let me go back to my little face. So next I want to talk about this big brown bucket. And the big brown bucket is what I'm going to illustrate, the 401k type of account. And again, that could be a 403b. It could be a 457 if you work for the government. But the point is, this big brown bucket is, okay, I guess I do need my big face to show you the big brown bucket. I just want you to know it's a big bucket. It's a big bucket because a 401k is a relatively large type of account. Like, you can put a lot of money in your 401k. So that's what that is. It has certain protections. It's tax deferred, which means if you put money, not only do you get a tax deduction, but if you, let's say you invested in Apple stock in your 401k, some companies will let you do that. Especially if you happen to work for Apple, you could have a lot of Apple stock in your 401k. And let's say you worked there for 20 years and you decided to sell it when the price of the stock was at the moon, and you bought it when it was in the commode. When you sell that Apple stock in your 401k, you don't have to pay tax. It's deferred. So you get to make that transaction, which would be a huge amount of profit if you did it in this bucket, and you would have to pay taxes in the year that you sold the stock if you had the money in this bucket, the Apple stock. But if it's in your 401k, you don't have to. It's tax deferred. That's what I want you to understand about these tax advantaged investment buckets. It's really important to understand. And if you can put a lot of money in there and have a big tax deduction and have a lot of assets growing where you're trading them, you're selling them, you're selling them when they're high and they're buying more back when they're low, just like Farmer Joe, over time, this bucket can really produce some wealth for you. And the benefit of being able to sell that stuff while it's high without having to pay tax is a huge benefit. It's a factor, a major factor in building wealth. So that's the 401k type of bucket. Whenever you leave a company, and I'm looking for questions, I don't see any questions, so I'm hoping you're following along so far. But when you leave a company, and you're going to study this week, it's part of your reading and understanding. You'll watch a couple of videos that will illustrate it better than I can. But the point is, when you leave a company, you go from company A to company B, you don't get to keep your 401k. You get to keep the money, but you have to roll it over. You've heard of a 401k rollover. Well, what you do is you roll it over into this bucket. This cute little bucket, it's not as big as this bucket, but it's a good-sized bucket. It's a very important bucket, and it illustrates the traditional IRA. This is the bucket you would roll the money over into when you leave one company. I know you can hear that. It's probably annoying. But anyway, this is a traditional IRA. It's a tax-deferred type of account. And you can use this type of account. Let's say you work, like I have you can contribute to this type of account in addition to your 401k. It's an IRA. IRA stands for, everybody thinks, and I use this term all the time, we all think that it stands for an individual retirement account. That's fine. That works. It's pretty accurate. But technically, an IRA stands for individual retirement arrangement. So you might want to put that in your class collaboration note just to make me smile. But that's not the one, Ava. That's just a thought. IRA stands for individual retirement arrangement. But we say individual retirement account. And that's what this bucket is for. It's got its own set of rules, boundaries, and limitations. But it's tax deferred, it's tax deductible, and it's a really important piece of your financial life, because when you leave one company and you lose that 401k, you roll it over into this. And that's where then you get to manage that investment in your IRA. So it goes from your company managed investment account into your own investment account, where you very likely will have an infinite amount of options. That's where guys like me come into play, investment managers, financial planners, where you've accumulated a good deal of wealth and now you need a little help because you're not sure what to do with it. And this, while it doesn't look like a huge bucket, you can have a lot of money in one of these buckets. Because if you grow a lot of money in this bucket and then you change careers or maybe you retire, it always gets rolled over into an IRA. That's an IRA, individual traditional IRA. That's that bucket. This little bucket right here is my favorite bucket. And I think it was January of 1998, the IRS came out with this thing called a Roth IRA. It's a tax-free investment account. It's the only tax-free investment I know of. So the way this works is a little bit different than this one. Like I said before, you could contribute up to the annual limit, and you're going to have to learn what the limit is this year. It's part of your homework assignment. You're going to have to learn what the limit is that you can contribute to a traditional IRA. But the same limit applies to this Roth IRA. So you can choose. Let's say this year I think it's $7,000 if you're over 50. So I could put $7,000 in an IRA, or I could put $7,000 in a Roth IRA, or I could split the difference. What I can't do is put $3,500 or $7,000 in this bucket and $7,000 in that bucket. I can't do that. Now, you might be wondering, why would you want to put money into this bucket instead of this bucket? And that's a great question. Ava, it's not our class collaboration question, but it would be a great one. It would be. And it may be one of the questions that I ask you in Money Study Group to just think about and comment on. So thinking about things is really a big part of this course. It's really a big part of personal finance, so we do a lot of thinking. Okay, so back to this bucket, this Roth IRA bucket. Again, it's a tax-free type of account. And I used to tell a story, and somewhere out there I posted an illustration. I'll try to find it and maybe post it to your playlist. It's a pretty cool story, but it's a story about back in 2009, a buddy of mine, we were both investing. We're talking about different things to invest in. If you weren't around in 2009, we had what we call the Great Financial Crisis. And so stocks were just terribly in the commode. And Apple was trading at $105 a share. And I don't even know what it's trading at today, but I did a video with all of the numbers that showed you what would happen if I would have had $100,000 in my Roth IRA back in 2009. I didn't do this. I wish I would have. Man, I'd be so wealthy today. Because what would have happened if I had $100,000 in my Roth IRA, and if I would have invested it all in Apple stock, I would have had in my possession, in my Roth IRA, I would have had a certain number of Apple shares. I'm not going to go through the numbers today, but I just want you to think and imagine. And what happened with Apple stock over the years is the price just went up and up and up and up. And the company actually reverse split the stock. So if you bought it and you had 100 shares, they came along and they did a reverse split. So now instead of having 100 shares, you had 700 shares. And so time went on and the stock kept going up. And then again, they came along and they did another reverse split. So they multiplied your number of shares. Again, if you had 700, now you had 4,900. And the price of Apple stock today is more than $105 a share. I want to say it's like 160, but I should check. I'm going to check because I'm curious. I'm going to just jump in here and check to see if I can find Apple stock. Maybe I'll show you. No, I'm not going to show you. I'm just going to look. Does anybody know what Apple stock's trading at today? If you do, post it. Looks like the market is kind of flat. I'm looking for Apple stock. There it is. It's trading at $169 a share. So I'm just going to show you. Maybe I can show you. Yeah, let me get rid of that. Nope, I'm in the wrong one. Hold on. There we go. So now you're seeing Apple stock. Now it was trading all the way up at almost $200 a share. But remember, in 2009, it was trading at $105 a share, and the company reverse split the stock, didn't reverse split it. They split it, so you would have like 50 times number of shares you had when you started out. And now it's at $160 a share. So the point is, you would have in this account millions of dollars. And I did the numbers, I did all the math, I did all the splits and showed you the math, and it was amazing. But the point that I was trying to make then and the point I'm trying to make now is your Roth IRA is a great tool because if you have big gains, if you make a lot of profit, you never have to pay the taxes. Unlike the 401k and the traditional IRA, those are tax deferred. So that means when you get to be my age, I'm 61 years old, if I want to start taking money out of my IRA, when I take $50,000 out of my IRA, the government, the IRS says, okay, Mr. Munchback, you took 50 grand out of this bucket and you got a tax deduction when you put the money in, which means you did not pay taxes when you put the money in. But now that you're taking the money out, you have to pay taxes on every dollar you take out. So when I take money out of this account, this IRA, I have to pay taxes on it. And that's what's different about this one. If I put all my money in a Roth IRA, then when I take the money out, I don't have to pay any tax on the growth. That makes this a very unique, very cool piece of work. the Roth IRA. So those are the buckets. If you have any questions about the buckets, now's a good time to ask. I'm going to go back to my... Okay, there we go. We're back to the post. And I think I got rid of the... Yeah, we covered all of the things on that little list right there. Let me get rid of that. And I'll put that back up. So now I'm just going to give you a minute to ask any questions. And Ava, this is your time to shine because we're about to do class collaboration. You said the class collab has to do with earning. Don't forget to mention it. Nice. You're great. Okay, so I'm about to mention it. Let me get rid of this. There we go. So these tax allocation strategies are interesting because there's one thing and this is, by the way, it is now 10:40. It looks like 10:41 a.m. It's weird because my Apple Watch says 10:41, but my computer says 10:40, and it's an Apple computer, so it just changed to 10:41. 10:41 a.m., 31 October, year of our Lord, 2023. This week's class collaboration has to do with earning, and I'm going to tell you a secret word, a secret code word in a minute. But I just want to say, truthfully, that all of these strategies, these tax allocation strategies, require that you have earned income. Like you can't put money in a tax qualified account. You can't use tax advantage investment strategies if you don't have earned income. Okay, so earning is really important. Now, somewhere in my world, I have a pink shovel, a little, kids' pink sand, play with, you use this to play in the sand. And probably that's where it is. My granddaughter, Maddie, let's see if I can show you Maddie. That's Maddie right there. You can't really see all of her, but that's Maddie on the left, Caleb on the right. That's my screensaver picture. But somewhere along the way, I think maybe Maddie and Caleb have my pink shovel. And the pink shovel is key. The pink shovel is key because for me, every time I've taught this lesson, I've pulled out my little pink shovel and hold it up, and I talk about what it means to be an earner, what it means to have some skill, something you contribute to the world that solves some problem. And I use the pink shovel as my prop in telling the story that I'm about to tell you. But I lost my pink shovel, so I don't have my pink shovel. So you're going to have to imagine that I have a pink shovel. It always lived in these buckets, but these buckets have gone all around the country to teach this lesson, and now somewhere along the line, I lost my pink shovel. I'm pretty sure Maddie or Caleb took it. They do that. They live at my house, and I love it, and they're great. But did I tell you guys I lost the keys to my motorhome that's in my driveway? I have this great motorhome that sits in my driveway, and I had 2 sets of keys. Totally lost. Took 6 weeks to find them. We found the other set of keys this week. The first set of keys that we lost were in my motorcycle trunk. Okay, that was on me. I forgot. So yeah, I was going to hire a locksmith. It was going to cost over $1,000 to get this motorhome rekeyed. It's a big deal. But we had 2 sets of keys and we lost both of them. How does that happen? We had no idea. But this week at dance class, my wife was with Maddie. My wife Connie was with Maddie, our granddaughter, at dance class, and her dance bag fell over. And Connie, my wife, went to pick it up, and when she did, all the stuff had fallen out on the floor. And guess what was in that stuff? A beautiful set of keys to our motorhome. Maddie had them. And Lovey, that's what they call Connie, Lovey, not Granny, but Lovey, she said to Maddie, how long have you, what's eat? Because we've been asking everybody, we've been looking and looking and looking for these keys, and the grandkids knew we were looking, and they promised they had nothing to do with it. And Maddie said to Lovey, I forgot that I put them in there. So that's probably where my pink shovel went. I'm just saying. So back to the pink shovel. Thanks for letting me tell stories. So the pink shovel represents work, okay? And I told you that these strategies that we're talking about today, you have to have earned income to be able to take advantage of them. And building wealth, real wealth, generally requires you to have the ability to use some tax-advantaged investing. And that's why we talk about it every semester. But I tell the story about the pink shovel because that pink shovel was just a stupid little thing that I found along the way. And I use it because when I was about 11 years old, this was a life-changing experience. I'm about to tell you a silly story, but it's an important story in my schema, in my life history. When I was about 11 years old, I was a pretty big kid. And I think I was 11 years old, and we had we had 4 kids in the family. My mom didn't work. My dad did work. We weren't poor. We certainly didn't think we were poor, but we didn't have a lot of extra money. And my mom bought tennis shoes from Kmart. I don't know if you guys know what a Converse tennis shoe looks like, a canvas Converse tennis shoe. They still make them. And back then they weren't cool. They were just cheap. Okay. Today they're kind of cool. A black canvas Converse tennis shoe. I should show you a picture, but I don't have a picture. Poor planning. Anyway, those shoes were cool. Yeah, I love Converse too. I still have some. But those canvas, we had 2 choices. At Kmart, you could buy those shoes for $4 a pair. And I think it was $4. It was either 4 or 6, but it was cheap. So with 4 kids in the family, 3 boys, that's what we got. We got Converse canvas tennis shoes. And typically we got the low tops, not the high tops. Eventually we could get the high tops, but we were limited. We could tell Mom we want the black ones or the white ones, the canvas ones. But then all of a sudden there's this guy called Julius Erving who we called Dr. Dunk. He was awesome. And he could dunk any way you could imagine, dunk a basketball. And he endorsed these Converse tennis shoes that were leather, high-top leather Converse tennis shoes. And you could buy them at Kmart at the same store, but instead of $4 or $6, I'm not sure which, I remember they were $10, which was like a 50% increase, give or take. And I wanted those shoes. All my friends had leather Converse tennis shoes, and I wanted them really bad. So I went to my mom and I said, "Hey, Mom, would you mind getting me some black leather Converse tennis shoes?" And she said, "No, we can't afford that." And I pestered her because my mom really liked me. I think she liked me the best. I'm pretty sure I'm going to go see my mom in 2 days in Michigan. My dad has passed, but my mom is still doing great. And I'm pretty sure I'm still her favorite. Okay, I don't tell anybody in my family that. But anyway, I went to her again and again and again. And I'm like, "Mom, please, please, I want the leather Converse tennis shoes. These other ones are ugly. They're old. They're outdated." She told me finally, "Go talk to your dad." So I wasn't afraid of my dad. I really liked the guy. He was fun. He worked a lot. Found him one day and said, Dad, I got this thing going on here. All my friends have leather Converse tennis shoes, and I really want some. So would you mind if Mom goes ahead and just gets me that instead of the other thing? It's it's a little bit more money, but what do you think, Dad? Can we do that?" Dad said, "I'll tell you what. I'll make you a deal. No, I'm not going to buy you the leather Converse tennis shoes, but I'll make you a deal." He reached over in the corner and he grabbed a snow shovel. Now, I grew up in Lansing, Michigan. They get lots of snow. It was winter time. It just so happened that it was a Saturday. My dad was home on a Saturday, which he wasn't always home on a Saturday, but that day he was home, and he handed me a snow shovel. Thus, the pink shovel that represents earning. My dad told me if I wanted those leather Converse tennis shoes, that he would give me the opportunity to use his shovel and go out and earn the money. He said, all you got to do is knock on the door of each of these neighbors and then go all around the neighborhood, knock on the door, and tell them that you would be happy to shovel their snow if they would pay you a little money. And he said, you can decide how much money you want to charge them. Or you can let them tell you how much it's worth. Either way, you knock on their door, you ask them, do you want your snow shoveled? And we got a lot of snow. But again, I was a big kid and I was like, are you kidding? That sounds like fun. So Dad said, now if you break my shovel, you have to buy me a new one. I'm like, oh, now we have risk. It's like, okay, I won't break the shovel. It's snow. I'm not that strong. So I go out, I knock on a door. I don't honestly remember if the first person I knocked on said yes, but it wasn't like, it didn't take 3 or 4. It was 1 or 2. I knocked on the door, and here's this red-faced, pudgy kid in Michigan with a snow shovel asking if you wanted your snow to be shoveled. And you had a lot of snow, and people were like, yeah, that'd be great. Go ahead and do it. I'll pay you. The first person I did it was the Turner's house, and they paid me $10. Now, $10 is a truckload of money. They had a big driveway, a long sidewalk, and the snow was like 2-3 feet deep. It took me a while, but when I finished, I had money in my pocket, and I went on to the next one and the next one. And before it was all over, I had friends. I'm like, come help me, bring your snow shovel. I'll knock on the doors. We'll shovel the snow together. And by the end of that day, I had a pile of money in my pocket. From that day forward, for the rest of my life, I never went through a season where I couldn't earn money. I couldn't figure out some way to find some need in the community that I could provide a service to fulfill so that I got paid some money. And I'm not like super wealthy. You know, I've done okay. I've done pretty good. I've done way better than I ever dreamed. But the way that I did it was so super simple. I worked. I was always willing to look for opportunities where there was something that needed to be done, and then I had to learn some skill to be able to do what was needed so I could provide some value so that I could receive some money in return for my work. And that's how you earn. And so that's the story of, going from wanting leather Converse tennis shoes to learning how to knock on the door and ask somebody if they wanted their snow shoveled. And then the next spring, when the spring came around, those same people had, they had work that needed to be done in their yards. Their grass needed to be cut. Their leaves needed to be raked. And it was like a perpetual money-making machine. From then on, when my dad introduced me to earning, it changed my life. I never went without. Anything I wanted, I could buy. I could make my own money, and I could buy it. When I turned 16, I decided I wanted to leave home. Had a lot of rules at home. I didn't like rules. I liked freedom. Seemed like freedom was somewhere else. So I saved enough money to enroll in a trade school. And when I turned 16, I went to my dad and I said, Dad, let's have a talk. And I told him what I wanted to do. He wasn't very happy, but he appreciated me asking his permission. And he said yes. He said, if you need money, though, don't call me. I'll send you an airplane ticket home, but I'm not going to send you money. And so I set out very early in life on my own, learning skills to provide a service so that I could make money, so that I could have the things I wanted. And next after that, after I went to trade school, was going to college and having a skill during college to fix cars. I went to trade school, Denver Automotive and Diesel College. But it all started that day with a shovel. And so the pink shovel that I don't have is the illustration for earning. And it all boils down to when you find something that needs to be done, some service that needs to be done in your community, in the world, and you develop the skills to go do that and do it better than anybody or work harder than anybody to do that thing that needs to be done, you will find the same thing I found in America with all of our problems. We have more problems today than we've ever had. But one thing is true. In America, it's still the best place on the planet to earn, to take your skills to the market and do the work and get paid. And so that's kind of one of the things I wanted to share with you that I think is important. No matter how smart you are, no matter what I teach you about investing and managing money and personal finance, none of it will make much difference if you're not willing to work and earn, because that's where you really build wealth. So that's the story, and that's what I want you to talk about in this week's class collaboration is work and earning. And what's that like for you? What's it like for you to be willing to work, willing to learn the skills to go out and earn? And sometimes for many of us, that means taking the risk. When I knocked on those doors, I did not realize what I was doing was selling. Okay, I have been in sales all my life. I don't even think of it as sales. It's just being willing to take a risk, knock on a door, and say, I would like to work for you. That is selling. And you have to sell yourself if you want to get that dream job that you've pretended that you already have. If you want to get that job, one day you're going to have to sit in front of somebody like me who needs to hire somebody to do something that needs to be done in my company. And I'm looking for someone who will show up every day, who will do the work, who will be kind of fun to be around, who doesn't make all kinds of excuses and just wants more money, more benefits, more time off. I want somebody who's going to show up and do the work. And I'm willing to pay them. If they convince me, they'll show up and do the work. And I'm going to keep paying them if they keep on showing up and doing the work. And that's kind of something that seems to be less and less and less cool these days. And so I want to encourage you with the one thing that I know to be true, and that is if you're willing to work, develop the skills, show up, and don't be afraid of selling yourself once you've prepared yourself to do that job, because that's what will set you apart from all the other folks who show up wanting that same job. And I hope that makes sense to you. And that's really what I want you to talk about a little bit. I know that's a lot, but it's kind of a philosophy. Some people call it work ethic. Some people call it the ability to earn. You call it whatever you want, but talk about that this week and share a little bit from your heart and your experience and your life about what it means to work, what it means to earn, what it means to be out there and be confident in what you can do to contribute to the world you live in by providing some service that meets a need with your energy, with your skills, with yourself, and with a smile on your face. I think that's it. So no questions, no comments. We're getting really close to the end of our semester. It's been fun. Capstone's coming up, and I'm going to be answering questions. If you've got questions about your capstone, about your financial plan, you can send me those questions. Be specific, and I will do my best to answer them and give you some tutorials along the way. So I think we have one more assignment after this week's assignment. I think it's the blueprint. But anyway, this week is tax allocation. So good luck with the assignment. There's lots of resources in Money Study Group. There's a quiz, and don't forget the class collaboration. And the key word is pink shovel. Thanks, Ava, for the reminder. Any questions? Ask now, or going once, going twice. I'm going to jump over to the stream, and I'm going to end it